This is Eric Mwatha with Mwatha.com for the first week of July 2012. Let's take a look at the charts here. We see that the Nasdaq on a weekly basis has managed to move its price above the 10-week moving average and now back above the 33-week moving average, which really is the first thing the market had to do if it was going to recapture its lost ground since May of this year. So, right now back above this moving averages, momentum can stay to the upside if the market can hold levels above that 10-week moving average, which is no longer declining. As you can see, the 10-week moving average is now starting to turn around. That's how you build and move higher after a pullback. Now that's the Dow, that's the Nasdaq weekly chart. Let's take a look at the Dow from a weekly chart. Also see that the Dow had managed to move its price above the 10-week moving average right there, and now the Dow trading above this level here, 12,810, which was the weekly closing high of 2011. So we are in this what could be resistance area here, around that area of 12,810 on the Dow. But as long as the market stays above the 10-week moving average, we can assume that this market wants to move higher. Now let's take a look at some world markets. But before that, let's take a look at the S&P 500. S&P 500, like the Dow and the Nasdaq, also back above the 10-week moving average, which is now no longer declining, and you see it stabilizing. And that could be what all the market needs for it to move higher, the fact that the 10-week moving average is now not pointing to the downside. Also, the S&P 500 is back to the weekly closing highs of 2011 at 1363, trading exactly just a tad bit below that level on the weekly basis. We'll see whether that is going to still remain some resistance to the upside. But a net on a weekly chart, the fact that the averages are back above the 10-week moving average, that's a good sign for the market. Take a look at the Brazilian market. We saw a nice move Friday, last trading day of June, and this all began as the market here seemed to have been making lower lows here. You see that the technical picture on the RSI was improving, which led to that jump. Also happens to be an area where this line happens to be an area where this market is bouncing off on the backside of it. So makes sense there. Also notice that the MACDs were also now forming a positive divergence. What this suggests here is that as the technicals improve and you had this surge, is that this movement here in the market could be trying to push the market to make contact with a declining 50-day moving average. So really net it could be a weak rally at best for now, because remember, we have a declining 50-day moving average and we are ways off that. So any rally, any movement in the market is always going to be looked at with a skeptical eye. In other words, you want to sell the rallies until the markets can recapture and stay above the 50-day moving average. So right now, there is going to be natural resistance at best around the declining 50-day moving average. So could be what we call a bear market bounce, or dead cat bounce, just because it doesn't have technical strength. If you take a look at the Brazilian market, here's an example of world markets as we seem to be bouncing off this line here, which was the lows going back 2008, lows of 2011, and we seem to be holding steady right there, which is okay. That's good, but we are trading decisively below the declining 10-week moving average and the 33-week moving average. So really no rally strength at all. So even though the markets had a positive close towards the end of the last trading days of June 2012, it seems like markets still continue to be under pressure. If you take a look at the German market, it's trying to move out of this declining wedge type formation here with this move here, which was about 4.33%. Problem is, it's now back at close to just above the declining 50-day moving average. So that's not, you don't see strong rallies when the 50-day moving average is declining. You need the 50-day moving average to start pointing higher, just like it did here before you can have a sustained move down the road. So as long as the 50 is declining like it is right here, all rallies are going to be looked at with a lot of suspicion as far as I'm concerned. The Indian market, I like this chart because it shows a market that is really jumping and moving above the 50-day moving average and above the 200-day moving average. See that breakout right there? Had a consolidation period somewhere here, which was just about the 200-day moving average, and then we had this strong move about 2.6%. It seems like a breakout even on the RSI here. So we are seeing some markets that want to move higher. What is encouraging about this chart and why I was sharing is here's a market that is trading well above a flat 200-day moving average and a 50-day that could very soon stop going down and start trending to the upside as long as it remains above that price range. So here's a market that is showing strength. You see that the RSI for the first time in a long time is moving above this area here, which has been resistance ever since we broke down here, which corresponds to that high. We've not been able to move above that area there and also here. So this move here is really something different. It's something we haven't seen in this chart for a while. So this could be a short setup for a short-term move to the upside with that move there. We'll see whether it holds. Again, even the technicals seem to be breaking out of a range, as you can see, a multi-month breakout here on the MACD. So the Indian market could be showing signs of life. The only problem is once you start looking into the monthly chart, you start seeing areas of resistance. If you take a look at the Indian market from a monthly chart, you see that this area here has been upside resistance going back to beginning of 2011. This has been an area of resistance. So we see whether we're going to continue moving higher here or we're going to stall, as has been the case over the last year and a half. So we'll see how things, just watch this space to see how things turn out. Also notice that it ended the month of June above 50. Any move below 50 going forward is going to lead to a significant move lower. Remember, we had a 7% jump in the Indian market in June because it moved its RSI back above 50. So any opposite action with a move below 50 could lead to a significant pullback in that market. The Indian market from a weekly chart, again, you see even though the dailies are showing a breakout, notice that if you take these highs here on the weekly chart, draw a straight line, we are back in this general area where could be natural resistance. So again, the dailies were showing a breakout, but the monthlies and the weeklies are showing us a we need not just assume that it's a bull market going forward. Here's a chart that was really breaking down fast. If this was the low, going back to beginning of October 2011 as far as the crude oil and the USO is concerned, and we saw it touched that level and perfect bounce. So for now, especially given the fact that we were making these new lows here with an improving technical picture, crude oil might be staging a short-term net week on week move to the upside, because we have at least a short-term target, which is going to be the declining 50-day moving average. My interpretation of this is that even though the market might be moving higher here, it's not really back to a strong market because we have a declining moving average and we have also a declining 200-day moving average. In other words, all rallies as far as the crude oil is concerned and in the USO also should all for now be looked at with a lot of suspicion. A lot of suspicion because we have very steep declining moving averages. So net short term found support where it needed to find support at last year's lows and jumping to the upside, but this is not necessarily the end of trouble for this market. This USO crude oil charts to me look like they're going to be testing these lows here in the next couple of weeks, just based on the fact that we have a very much broken daily chart. If you take a look at gold now, gold did manage to trick some of us to go short as it was breaking down here during the week, but it managed to turn around and close to the upside. Also notice that we are stuck in this very tight range as far as the weekly RSI is concerned. Very tight range here. So we are either going to break out or break down. As you can see with the arrows, we had a triple bottom here on the RSI, and we also have multiple levels of resistance on the top side of the RSI, as shown by the red arrows here, here, and here. So this narrowing down in gold is either going to explode to the upside or break down to the downside. Right now, it's almost in no man's land. Remember, gold is finding support here where it's been holding. It's held there and it's holding this level there. So there is support on the downside, but we still have to wait for this area here to tell us where this market wants to go. Here we could, like I said, break out, which is time to go long gold, or we could break down and we could try and short gold again. If you take a look at the gold from the main index, the gold index, you see that this area here, gold at 1556, which was a breakout and a high here, this level has been where you find gold has been holding steady. Every time it drops, it finds support there and there. So as long as it's trading above this 1556 area, gold could be in play. But for now, we'll see how it what it does. If gold can manage to break out above this line here, then it might have a nice move to the upside. For now, I think it's in no man's land, but like I said, it did manage to trick us as we went long the DZZ as it was trying to break out. As you see there, this is 2 times inverse gold. You see that the 50-day, the 200-day are all moving to the upside, and I thought it was time for it to break out of this almost 10-month range here. But as you see, we had a nice move, and the next day we had a big sell-off in this instrument. So that was a fake breakout. The reason why we thought that was a breakout is because on the weekly chart it was breaking out above 5.15, which is a closing high here. So it was trading about here. It seemed like a breakout, and we had the signs of a move of a crossover, bullish crossover between the 10-week moving average and the 13-week moving average. So that seemed like a breakout. It turned out to be, it was a trap. So it stopped out when it moved back below 15.15. But in the future, when you see this instrument DZZ move above 15.15, that might be a buy signal again. Even though we see that on a weekly chart we have a triple top on the RSI, which makes me wonder whether it's ever gonna see this level here in the coming weeks. We'll see. Maybe now it's positioned to go down, but gold is gonna tell us whether it's gonna break out or break down as far as the RSI is concerned. So it's kind of like a wait and see formation. I think if this thing can manage to capture the move, if it can move above this level here, that could be time to buy it, because this crossover here might suggest a long-term change in sentiment and direction for gold. But if it doesn't move above 15.15, there's no need to short gold at all. All right, let's take a look at the dollar here. The dollar is now back below 81.52, which was a breakout point there. It broke out and was trying to hold. So it's trading, I would say, still above this level here, closed at 81.63. So it's still trading above that level. Ever since we moved above this level at 81.52, we've not closed above it or below it. So we are still holding steady there. So it's kind of hard to read here what the dollar is trying to do. If it moves back below 81.52, then that's a sign that the dollar wants to move higher, and the dollar wants to move lower, and gold wants to move higher. But in the future, if we continue trading in this range, consolidating, and we eventually break out of 81.83, that breakout on a weekly chart is going to mean that gold is back, the dollar is back at 52-week highs, and that might be time to stay long the dollar and stay short gold. For now, I would say, again, no man's land, because we are not breaking out and we are not breaking down. It's hard to read until we get either a breakdown or a breakout between these two levels as far as the dollar is concerned. So again, just like the gold chart, this is almost in no man's land at the moment. Now, one of the things I wanted to point out here on a word of caution for those of you who are long this market is, let me draw a straight line here. This is this line here on the Dow, on the Nasdaq weekly chart. So we've bounced off this line twice. That's what the chart looks like here. Problem is, if we find ourselves breaking down on this line here, which is what I'm trying to show you here, if we break down, that break is going to lead to a massive sell-off. So even though right now the bounce is good, we see that the market is bouncing off this line which connects the lows there and there. So it's bouncing off this line, which is good. Problem is, if it breaks below that line, you don't want to be long the market because it's going to be a scary drop. This is a Dow monthly chart, same scenario. You see that we are bouncing off this line here, which is good. Problem is, and a word of caution is, if we break below that line, that's going to be a massive sell signal. So let's keep an eye on that too, on that formation. Also notice that on the dailies, even though the market had a nice close to the month of June, notice that we are back at these levels here, and this could be an area where this market was just probably trapping us to go back on the long side before it turns around. So be careful on that. If you take a look at the Dow on a daily chart, you'll notice that we are back at this level here, which has been resistance. That was resistance and the high. That was resistance and was a high there, and this right here could turn up to be resistance. So be warned that this market could be trapping us. Also on the Dow 60-minute chart, you'll see that we have this area here on the Dow 60 is where we could have resistance. We had resistance there, which is the high. We had resistance there, which was that high, and this could turn out to be a resistance area, and that area with the Dow about 12,880 could be the high short term. So a word of caution, even though the market was trying to move higher, this could be a trap also. Eric Moore with Mother.com. Good luck, peace, and blessings.